Hello everybody and welcome to Green Star Trading with me, Tom. All views, opinions and ideas expressed in this video are my own and do not constitute financial or trading advice in any way. Right, for the next few minutes we're going to be looking at the Russell 2000 ETF, the IWM, and we're going to be going over a couple of Elliott wave counts, and we're going to be looking at some interesting levels as well. Going to be a pretty short video this one, as there isn't really much to discuss in regards to, well, the last several months for that matter. So without further ado, let's get underway. So we're going to start here with the bullish interpretation on the day time frame. So just to sum up, I think we're in a cycle wave 5. We've done primary wave 1, primary wave 2, primary wave 3, and we may have completed primary wave 4 just recently. And we now have either a wave 1 and a wave 2, and we will now push up into a 3, 4, 5. But I have doubts here, because this is either a diagonal into a 1, because it definitely isn't an impulse. So it has as much chance of being corrective to a further downward move as well. So essentially, we've been consolidating and doing nothing since March. I'd argue since February, because that's where I have the primary wave 3 in this count. So bullish day yesterday. Pre-market's currently trading above yesterday's close. Little gap we opened on the open, little gap up. Haven't seen a gap up like that off of the low during this long-term consolidation quite as convincing as this one. So maybe we are finally going up. But whereas the SPX and NDX made new all-time highs again yesterday, DJI hasn't yet, but as I pull out in my Monday video, I believe that it's still got room to go higher, that it's in an ending diagonal, likely in the 5th wave, and will probably make new all-time highs, along with the other indices. But the IWM has just been hanging around here for months on end. So that's the bullish count. 1, 2, 3, 4 is complete. We will start moving up from here. Now let's have a look at the bearish count, which I honestly find a little bit more interesting. So we have either built a base of support here around our point of control on the volume profile. This is either a launch pad to go higher, or this is the peak, and this is just a mountain range and we're about to tumble off of it. So the bearish count, which is the one which is obviously, since not making a new high, has refused to die for months now, is that we topped out, 5 waves complete, and the IWM is leading the way down and peaked before everything else. We had 5 waves down into a 1, A, B, C into a 2 at intermediate time frame, then a 1, 2 at minor time frame, then a 1, 4 at minute, 1, 4, 1, 2 at minor time frame, 1, 2 at minute time frame, 1, 2 at minuet time frame. Potentially now this could be a 5 wave move down here on a smaller wave degree. So if this one's correct, then we're going to break down violently. Now why do I say violently? Well, let's have a look at our volume profile here. Here's the peak of the volume, our point of control, given that this is a visible range. Okay, so everything on the chart that we can see is accommodated by this volume profile here, and as you can see, this is price data from back late 2020 all the way down to March 2020, all the way up to here. And a rather peculiar feature for a chart is to have a established point of control at the top of the chart rather than below the price. If you look at the SPY, SPX, NDX, whatever, you'll find that the point of control is all the way down here, dashed line so to speak, and away from the price. Seeing the opposite here in the IWM, so that's a sign of just how much trading's gone on up here as we've gone back and forth. All the buyers, all the sellers, all hanging around here near the peak. The other notable thing is between our point of control and the next major peak in the volume profile is an empty gulf of just empty space. Okay, there's nothing in here. When I say nothing, I mean there's no market acceptance of all this pricing. So you can see if I bring up a level or two here, let me find the right one. That's a 38.2. Okay. So the 23.6 has been proving a floor for price, and has done for many months now. Now this is the 23.6% retracement of the primary wave 3. So from this here, of the low of the 2, all the way up to the top of the 3 here, this is the 23.6% Fibonacci retracement level of that move up. And as you can see, it's operated as support multiple times. So this is an important level. We can essentially call this, the baseline of this entire range that we've been in for months. So while this continues to operate as support, we don't break below this and import and then set an impulsive move down beyond this, we still have a perfectly reasonable argument that we're just building a base, a bullish base before breaking higher. But if this support breaks and we continue this 1 2 1 2 1 2 kind of pattern down, then I would argue we could get down here very, very quickly, because there's nothing in the way. There's no support in here. This came up too far, too fast. If you think about the small caps we're talking about here that make up this index, we got some serious over-exuberance in some meme stocks which belong to this index, and a lot of thin trading as a result. So very little very little market acceptance down here, very little support. If we do break this level, we will likely flush down. Now there are other levels of support below us for the bullish count. If we just refer back to that for a moment, I want those two levels. Get rid of these ones. Okay, so we do have support at the 38.2. The only thing I can point to and why it's come up as the 38.2 is we have this gap, this little peak, tiny little peak in the volume profile, plus we've got this gap here, a little gap between the candles right on the 38.2% retracement of the wave 3. So this could offer support, not likely to last, not likely to hold, not likely for long. If we break below the 23.6, I think this level could fall very quickly and we could continue to collapse if we break this level. Now all the way down here is the 50% retracement. Okay, now this is a slightly different fib. This fib isn't based off of a 50% of the wave 3. This is based off a 50% move from the high, from the March 2020 low to the high. So this is a different retracement, and this is for our bearish scenario. So if we just get rid of the other levels for a moment. Now that was a more recent one, so let's have a look. Get rid of that. Get rid of that. That. Okay. So here's our 50% fib, and this is our bearish count. We're stepping down 1 2 1 2 1 2. Now if we come back and make a new high and break out, this is completely invalid, and I'll throw my weight behind the bullish count because we finally have a breakout. Excuse me. Finally have a breakout, and if we see an impulsive move to new highs, then you have to be bullish. But while we're stuck in this range, it's a guessing game. So we're just looking for clues. So one other clue that I find interesting is we have a gap down here. Right here at the inside of the first wave, minor wave degree of what became the intermediate 3 of what became the primary 3. This gap is basically the first area of support we come into, which then goes into all this area of market acceptance and volume trading history here. Right, so this is an area of support. We also have the 50% Fibonacci retracement sat right on it, sharing the same space. So strong support here as well. Now if we were to fall, we may have to come deeper. If we just take a look at what some other fib levels. So working on our retracement, you won't be surprised to see that the 61.8% retracement is right in the peak. This the golden zone, the golden ratio here, yellow and orange as I use, right straddling the very peak of all this support zone down here. So here's your really strong support. Okay, so if we do break down, these would be the levels that we'd be looking for. So let's just lock this in place. We'll add one more thing to our levels. We'll do this in yellow so we know it's the 61.8. We'll get a price label down here, and we'll also get a little color coded lettering down here as well, so we can instantly recognize what we are looking at. 61.8% fib. So there you go. right at the peak of this volume down here, right at the peak of the volume profile, we have our strongest area of support is 61.8% retracement, which is the golden ratio. So what does that mean, or what could that mean? Well, for me, what I think we could be looking at here, now I know I've spoken about the idea that we're in a wave 4 and we're going higher into a wave 5. That's still possible, okay? But we have to appreciate that 6 months worth almost of price action which has been observable in the major indices has not been observable here in the IWM. So we can't say that they are doing precisely the same thing. We just can't do that. So that opens up the possibility that there's another counter at play across all the indices, including the Russell here, which is one we haven't considered yet. I will start considering it, which is the idea that we're actually putting in a 1, okay, and this will be a deep 2 before a much longer bull market continues. Now, I'm not saying that's the case, I'm just considering the options of the technical setup here. For the Russell, we seem to have a strong support level down here. Now, I know you could argue as a bear, if we're going to break down, and you'd be absolutely fair doing so, that this could simply make up the wave A, this area of support, anywhere to this, and then you have a bounce to test resistance, and then you flush down again. That would be absolutely legit as well, that this could just be the likely stopping area of the first initial flush down if we've peaked. But it could also be the support for a wave 2 of a much longer term bull market. Now, I find that hard to believe given the situation we're in, but it is a technical possibility, so I just thought I'd share that with you so you can go and ponder it. Now, what we're going to do is we're just going to get our new text and our new horizontal price label. We're going to put that in the levels as well. So if we want to turn them all on and off, they're all there. And that's all I've really got to discuss from an Elliott wave perspective. I'm going to leave the bearish count up here for the moment, save the chart. And all you're really looking for, guys, is a break out of this range, one way or the other. We break that 23.6, we're going to come down in a hurry. I see no reason why we won't flush lower. If we were to find support, the 38.2 would be our only stopping point on the way down. And then it's technical and structural support after that. So what do I mean? Well, we've got our 50 and our gap, but we've also got our previous high, right? Back here. This is near the gap, near the 50. Got a nice confluence of levels here. 50, fib, gap, re-entering some volume on the profile, fill a gap, previous all-time high. There's a bunch of confluence down here to provide support if we make it down here. Okay, but we've got to break out of this range either way first. The last thing I want to look at is, let's have a look at our pitchforks. That's the bearish one pointing down. That's based off of that 1-2 pivot. That's the long-term one. Not even through the 38.2 here on the long term. Nowhere near as aggressive as the SPY or the Nasdaq. And this one is a 1-2 pivot here using an ordinary pitchfork setup. So you can see from here that even though we've drifted out of this thing, here's the 1, here's the 2, here's the 3, right, 4, 5 top. Now this is the bearish case, so we've drifted out of it, putting a 1-2, putting the 1-2 to back test the pitchfork here, this bound of it, broken out of it here, come back to test the outer bound of it again, broken away again. So if we are bearish and we make another low below this range, we should really, and this is a 1-2, 1-2, 1-2, 1-2, 1-2, that acceleration will come in imminently and we'll make a big flush down quickly through all this space, through all this worthless empty space here. We'll call this the AMC GameStop zone, right? And we should come through this in a hurry, but only if we actually leave this range. So just keep your eyes on it. You break this range, you break through that 23.6, you've got to be prepared to see price tumble. If we get out the top of this range, maybe this was all a big consolidation. So let's do some basic technical analysis now. We'll clear the count out of the way and get rid of that impulse as well. And let's bring up our moving average ribbon. We have 4 exponential moving averages in this ribbon. We have a 10 in yellow, 20 in blue, 60 in orange, 250 in green. Let's bring up our momentum indicators. We have an RSI set to a 10 close with the green 30 level being oversold and the red 70 level being overbought. We also have a MACD that is left over from when I was considering the possibility of a triangle. It was not a triangle. We have a MACD set with a 10 for the short term, 20 for the long term for the moving average and the signal. Okay, so let's come out to the weekly time frame. Have a quick look at what we can see here. So obviously a big bullish move up and then the loitering around the top. So below our 10 exponential weekly average, having lost support here on the 20. Below the 20 now as well. Bullish, not a hammer the previous weeks because the tail isn't at least twice the length of the body here. But a bullish wick to the downside. We've seen these plenty of times before. All of this collection of wicks here. We're determined to keep the price above these moving averages. But as time's gone on, we've seen a couple of more bearish candles here. We had one more big bullish wick here. And we've got another one here. So it does look like a bounce from a basic analysis point of view. We've got this wick. We've got a little bit of follow through. Pre-market's trading slightly above this current week's candle, but we want to see, if you're bullish, you want to see trade above the previous week's candle and close above that previous week candle. A close above this high on the weekly time frame would be more bullish as well. So those are all things to look for. Get back above our point of control, get back above these moving averages, put in a positive week off of a bounce. Right. Bearishly, we already know, it's just taking out the lows here, isn't it? Take out this structure and you will get a crossover of the 10 over the 20. It will come down to test the 60. Now that moving average, I have to be honest, on the weekly time frame, I don't see any reason if we were to break down, other than that 38.2% retracement. That's the only thing which coincides with it, which could hold the price up, in my opinion. It might provide a bit more support than I originally thought, because now I'm aware of the fact that the 60 exponential is here in the same neighborhood. But even so, just look at the volume profile here. There's literally nothing in here. So I don't see any reason why we couldn't just continue to accelerate through this if we break down. I know I keep saying it. A long way away, even with all this consolidation. Even with months of consolidation, we are a long way away from the 250 exponential moving average. Now, if we come back further enough, taking enough visible data from the previous years, we can see that our peak here is not the point of control as it is when we're looking from the March 20 low. This is where all the volume is trading down here. In the volume profile, we know from our levels here, if we just bring them back on, that this is right in the territory of the 61.8% retracement, between the 50 and the 61.8. So this is where your major area of support is. We've got the 250 down here as well. Now on the weekly time frame on the RSI, although we've been going sideways, we've set this floor here at the 23.6, boing boing, couple of lows here. These are actually higher lows we've got, which have come to the 23.6. These were lower lows, but even though we've had lower lows to slightly higher lows with no higher highs, the MACD and the RSI had just been heading down the whole time. So losing strength, losing momentum. Same with the MACD, but this is quite common in a sideways consolidation. This is what you're going to see. As price heads sideways, we lose that upward momentum, so that makes sense. So essentially a bullish argument would be that you're losing momentum without the price crashing. You're basically cooling off the index, ready for another move up without having to actually crash the price. So it is a coin. I was about to say a coin toss. That's not right. It is a coin toss at the moment. It's a 50-50. This range determines everything. How price behaves once it exits this range is going to determine how severe the move up or down is. Because we have to remember, from a bullish point of view, if this is a wave 4, after a long drawn out consolidation, the expectation will be a thrust up into a 5. But the 5 technically doesn't have to go miles higher. It only has to clear the 3 and it could complete. So it could be a sudden burst, trap a bunch of people, a bunch of liquidity for people to unload for the institutions to unload their shares of the IWM onto the public, and then off we go. Then you could collapse. So for me, even though it's been a long time consolidating, I'm an Elliott wave trader primarily. I also do some spread trading as well, but as an Elliott wave trader, I've had my fun in the wave 3. I'm not particularly interested in trading the wave 5. If I see a strong impulse 1-2 and can identify a wave 3 at a smaller time frame, maybe that would tempt me in, but all the work's already really been done. So you'd have to be aware that a breakout doesn't necessarily mean moon. You know. Alright then, so that's a weekly time frame. Let's look at the daily. Okay, looking a little more bearish here on the daily, but we do have some positive things to talk about as well. We've got a double bottom on the RSI with a higher low. So we've got a low here and a higher low here. Low here and a higher low here. No divergence, but momentum supporting price action. So there's no hidden bearish divergence here, which is positive. You know, we haven't got bullish divergence either, but we've got momentum supporting price. Same with the MACD here. Low, higher low, low, higher low. So everything's working together here. But that means that this could be corrective, because you bounce to a slightly higher low before breaking lower. But having reached oversold conditions for a second time in a pretty short space of time, the most oversold we've been since consolidating. Haven't been this oversold before. A bounce is likely, but how long lasted? Does it bring us to new highs? Does it just bounce up again before failing? But the same feature, just declining momentum in both RSI and MACD. Back above the 10 exponential moving average on the daily time frame, just above the 20. We'll open above it today by the looks of it. So 60 above our heads. That stopped us before in this move. Get above that 60. Get a close for the week, as I mentioned earlier. Get a close above this high for the week. We'll get you back above all these moving averages on the daily time frame. We'll create an area of support underneath the price here, right around our point of control. That's really what the bulls need to do. If they want to step up and go to new highs, they've got to get above here, create some support around the point of control, around these previous highs, get an impulsive move up to new highs. If we fail in amongst this band, in amongst the ribbon here, and amongst the point of control, we don't take out that high, we come up to it, and then we fail, then I think a move down is far more likely. And will be interesting to see where we are in a week's time. Right guys, thank you very much for joining me. If you're new to the channel and you've liked what you've seen, please subscribe, smash the like, hit the little bell notification icon to remain informed of future video releases, and feel free to leave us a comment in the comment section below if you want to. Thank you as always to my patrons. Your support is greatly appreciated. We are now past we're now the 24th as I'm recording this. It'll be the 25th when this comes out tomorrow. So if you are interested in joining the Patreon, there's a link in the description box below. Feel free to go over and have a read of the tiers. There's a lot of stuff you can get: access to the Discord, access to my charts, access to my Elliott Wave course and training and trading videos as well, access to weekly exclusive videos, monthly deep dive videos, and a whole bunch of other stuff as well is all available for you. However, having said that, I would insist at this point that you wait until the start of the next month, because you get charged the day you join and you get charged at the first of the month. So I don't think there's enough value to justify a double charge within days. Totally up to you. If you want to feel that generous, feel free. But I would suggest leave it until the second of the month, so you don't accidentally sign up at the wrong time. Depending on your time frame, you could end up signing up at the end of the month, thinking it's the first. So just to be super safe, second of the month onwards, you will get charged once, and you won't get charged for the start of the next one. So there you go. Gives you a whole month to enjoy the pledge, pay your initial fee, and decide whether or not you want to hang in there for the following month. So, right, enough waffle. Also, if you're not following me on Twitter, there's a link to in the description box below as well. Alright guys, take care, and I'll be back with you later in the week. All the best. Bye bye.